The latest trade conversations between the US and China, the potential for more friction, the potential for more tariffs. How are you reading this situation?
Well, we have been saying that the US-China tensions will likely stay elevated across a number of strategic cohorts: trade, technology, geopolitics, and capital markets. So this continues to be our view. And in fact, we have a proprietary indicator which helps us quantify the implied U.S.-China tensions embedded in equity valuations. And the latest readings from our indicator suggest that the situation remains quite significant when it comes to U.S.-China tensions.
What do you mean by significant? What positions are you taking on the back of your indicator?
Well, we continue to believe that U.S.-China tensions will remain elevated. And is very much consistent with the latest observations from our indicators, which suggest that the market is already pricing in a pretty, I would say, tense outlook in terms of U.S.-China relationships.
In terms of the long-term effect of that, weave that in, if you would, with your analysis of the differing cycles that the U.S. And China economies are going into. What's the net effect of these different elements, and how do they inform your decision-making?
Well, I mean, the bottom line here is that we like the return prospects for Chinese equities. We remain overweight Chinese A shares, and we upgraded China offshore just maybe 2 months ago to overweight from market weight. And one of the key reasons for that change is really about the policy divergence that you just talked about. So clearly, the policy cycle in China has turned a corner from tightening to loosening, whereas in the US and the rest of the world is turning incrementally more hawkish when it comes to monetary policy as well as fiscal policy. So we think that that divergence of policy setup is going to be quite conducive to the outlook of Chinese equities.